Ever wondered why a good credit score is so crucial when securing a favorable mortgage rate? It's like a financial report card that lenders use to assess your credit worthiness. Imagine you're a lender for a moment. Would you lend money to someone with a history of late payments? Or would you feel more comfortable lending to someone who consistently pays their bills on time? Your credit score is that indicator, the number that tells lenders how likely you are to repay a loan. When it comes to first-time home buying, a good credit score can make a world of difference. It's not just about getting approved for a mortgage, it's about the terms of that mortgage. A higher credit score can lead to lower interest rates, which means you'll pay less over the life of the loan. Let's put this into perspective. Say you're approved for a $300,000 mortgage. With a high credit score, your interest rate might be 3%. Over 30 years, you'd pay about $147,000 in interest. If your credit score was lower, your rate might be 5%, leading to $282,000 in interest. That's a difference of over $135,000, all because of your credit score. So, you see, your credit score is more than just a number. It's a reflection of your financial habits, and it has a direct impact on your ability to buy a home. It can mean the difference between an affordable monthly payment and one that stretches your budget. It can influence how quickly you can pay off your mortgage or how much you have left to spend on renovations or vacations. A good credit score isn't just about getting the keys to your first home, it's about opening the door to financial freedom. So if you're planning to buy a home, start by focusing on your credit score. Now that we understand the importance of a good credit score, let's delve into how to improve it. Scene script. First things first, get a clear understanding of your credit report. Your credit report is like a financial report card, reflecting your credit history and behaviors. To understand it, you need to get a hold of it. Each year, you can obtain a free copy of your credit report from each of the 3 major credit bureaus: Equifax, Experian, and TransUnion. This is not a step to skip or skim. It's your opportunity to see what lenders see when they consider you for a loan. Once you have your reports, scrutinize them carefully. Look for any errors, discrepancies, or signs of fraudulent activity. It's not uncommon to find mistakes. These could be as simple as misreported balances or as serious as accounts you didn't open. If you spot any inaccuracies, dispute them. This can be done online, by mail, or over the phone. Correcting these errors can have a direct and positive impact on your credit score. But the importance of your credit report goes beyond just accuracy. It's also a tool to help you understand your credit habits. Are you using too much of your available credit? Are there late payments you weren't aware of? Are you applying for too much new credit? By identifying these behaviors, you can start to make strategic changes that will improve your credit score over time. Remember, your credit report is a snapshot of your financial behavior. It's what lenders use to decide if they'll lend to you and at what interest rate. By understanding your credit report, you're not just spotting errors, you're gaining insight into your financial habits and learning how to change them for the better. By ensuring your credit report is accurate, you've taken the first step towards improving your credit score. This is not just about getting a mortgage, it's about financial health and empowerment. So, roll up your sleeves, dive into your credit report, and take control of your financial future. Punctuality isn't just a virtue in life, it's essential when paying your bills. Consistency here is the key. When you pay your bills on time, every time, you show lenders you're capable of managing your finances responsibly. This has a positive impact on your credit score, making you a more attractive prospect for lenders. Think about it as building a reputation. Each on-time payment is like a brick in the tower of your credit worthiness. Now, you might be wondering how to ensure you never miss a deadline. Well, technology has made this quite simple. Consider setting up automatic payments for your bills. This way, payments are deducted from your account without you needing to lift a finger. Alternatively, you can set up reminders on your phone or email. Whichever method works for you, the key is to never miss a payment date. Remember, every on-time payment is a step towards a better credit score. How much of your credit card limit do you utilize? This is a question that should be on your mind if you're looking to improve your credit score. So, why is this important? Well, your credit utilization ratio, which is the percentage of your credit limit that you've used, plays a significant role in your credit score. To put it in simple terms, if you have a credit limit of $1,000 and your balance is $300, that's a 30% utilization ratio. Keeping your credit card balances below 30% of their credit limits is a good rule of thumb. Paying down credit card debt not only frees up more of your available credit, but also has a positive impact on your credit score. It's like a financial two-for-one deal. And who doesn't love a good deal? So, the next time you swipe your credit card, remember this. Lower credit card balances can lead to a higher credit score. A good credit history isn't built overnight. Indeed, it's a journey that requires consistency, discipline, and strategic financial management. One of the key aspects of building a positive credit history is maintaining a healthy mix of credit accounts. This mix could include credit cards, personal loans, car loans, or even a student loan. The key is to showcase your ability to manage different types of credit responsibly. Imagine this. Let's say you've been dutifully paying off your car loan for the past 3 years. At the same time, you've been using a credit card for everyday expenses, paying off the full balance each month. This paints a picture of a responsible credit user, someone who manages their finances well and can handle different types of credit. Lenders love to see this. But remember, it's not just about having these accounts, it's about making regular on-time payments. This is where the magic happens. Each on-time payment is a positive mark on your credit report, gradually building up your credit worthiness. Now let's talk about the length of your credit history. It's a major player in the credit scoring arena. The longer your credit history, the more data there is for lenders to assess your credit behavior. So if you have old credit accounts that you've managed well and paid off, don't be too hasty to close them. These accounts contribute to your credit history length and can positively impact your credit score. However, if you're just starting out with credit, don't be disheartened. It's never too late to start building a positive credit history. Just remember, it's a marathon, not a sprint. So maintain a mix of credit accounts, make regular on-time payments, and keep those old accounts open. These steps, coupled with patience and discipline, can help you build a strong, positive credit history. Remember, a strong, positive credit history can significantly boost your credit worthiness. And with that, you'll be one step closer to securing that dream home of yours. Scene script. Dealing with debt? Do it strategically. Let's delve into one of the most effective ways to manage your debt, by doing it strategically. This involves focusing your resources on paying off high-interest debts first, while continuing to make minimum payments on your other accounts. This approach, often referred to as the avalanche method, can save you money over time and help improve your credit score. Here's how it works. You start by listing all your debts, from the highest interest rate to the lowest. Then dedicate as much of your budget as possible to the debt with the highest interest rate, while still making minimum payments on your other debts. Once the highest interest debt is fully paid off, move on to the debt with the next highest interest rate. Repeat this process until all your debts are paid off. Why does this matter? High-interest debts grow faster than low-interest ones, meaning they cost you more the longer you take to pay them off. By prioritizing these debts, you're minimizing the amount of interest you'll pay over time. It's also important to note that maintaining your minimum payments on all accounts is crucial to this strategy. Missed payments can lead to fees, increased interest rates, and negative marks on your credit report, all of which can lower your credit score. Remember, the goal here isn't just to get out of debt. It's to improve your credit score and become a more appealing candidate for lenders, which can lead to better mortgage rates when you're ready to buy a home. Of course, this strategy requires discipline and a good budgeting plan, but with consistency and commitment, it's a highly effective way to manage your debt and work towards a better financial future. By managing your debt strategically, you're on your way to a better credit score. And with a better credit score, you're one step closer to securing that dream home you've always wanted. So start today, and before you know it, you'll be holding the keys to your new home. Budgeting isn't restrictive, it's freeing. You see, a budget is not about limiting your freedom, but rather, it is about creating a roadmap to financial success. It's about understanding where your money is going and making conscious decisions about how you want to allocate your funds. Creating a budget and sticking to it is one of the most effective ways of managing your finances. It allows you to keep track of your income and expenses, prioritize your spending, and save for future goals. For instance, if you're saving for a down payment on a house, a budget can help you determine how much you can realistically set aside each month. But here's the kicker. A budget is only as good as your commitment to it. It's one thing to create a budget, but it's another to stick to it. The key is to make your budget realistic and flexible. Don't be too hard on yourself if you occasionally go over budget in a certain category. Instead, use it as a learning experience to adjust your budget moving forward. Now, we understand that improving your credit can feel like a daunting task, especially if you're already dealing with debt. That's where professional advice comes in. If you're struggling to improve your credit, you might consider seeking advice from a credit counseling agency. These professionals can provide guidance on debt management strategies and credit repair. They can help you create a personalized plan to improve your credit, which may include creating a budget, paying down debt, or setting up a debt management plan. Remember, the journey to improving your credit is not a sprint, it's a marathon. It requires patience, discipline, and a solid plan. But with the right tools in place, including a comprehensive budget and professional advice, you can steadily build your credit over time. With a solid budget and professional advice, you can navigate your way towards an improved credit score. So, take the first step today and set yourself on the path to home ownership. Let's quickly recap what we've learned today. We started by understanding the importance of a good credit score when it comes to securing a favorable mortgage rate. It's not just a number, rather, it's a testament of your financial discipline and responsibility. We then dove into the intricacies of your credit report. It's essential to obtain a free copy from each of the 3 major credit bureaus and scrutinize it for errors or discrepancies. Remember, even a small inaccuracy can make a big difference. Timely bill payments were our next point of focus. They're not just about avoiding late fees, they're about proving to lenders that you can manage your finances effectively. Consistency is key here. Reducing credit card balances is another important step. Keeping your balances below 30% of their credit limits can help boost your credit score and demonstrate that you're not overly reliant on credit. Building a positive credit history comes with time and diligence. By maintaining a mix of credit accounts and making regular on-time payments, you show lenders that you're a reliable borrower. We also emphasize the importance of strategic debt paydown. High-interest debts can be a burden, so consider tackling these first, while still making minimum payments on your other accounts. Creating a budget and sticking to it is an integral part of financial management. It helps you pay off debt, save for a down payment, and avoid accumulating additional debt. Lastly, we discussed seeking professional advice if you're struggling to improve your credit. Credit counseling agencies can provide valuable guidance on debt management and credit repair. Remember, improving your credit score is a journey. Start early, be patient, and you'll be on the right path towards securing a favorable mortgage for your first home.